Hello everyone, today we are going to start a new section which is section C, business decision analysis. Before discussing in detail about business decision analysis, we should know about a particular term which is decision making. What might be decision making? You are most familiar with this particular term. Decision making is the process of selecting one option out of available various options. If we have at least two options in front of us, we have to select one that is best for the company. This is called decision making process. Now it's time to come to business decision analysis. As part of the company scenario, in day-to-day basis of business activities, the managers should take plenty of decisions, such as what kind of product need to be delivered to the customers, how to price for the product, that means cost-based pricing or competition-based pricing, how to deliver this particular product to the customers by ship or flight. These kind of plenty of financial decisions to be taken by the managers of an organization on a day-to-day basis. So in order to take such kind of decision without learning or without studying about it, we have to discuss or we have to learn in detail about the scenarios coming under each of the decision scenarios, and then only we'll take that particular decision. That is called decision analysis. So instead of taking the decision blindly, we have to take the decision by studying in detail about the scenarios coming under each of the situation. So this decision should be best optimum for the company, that will maximize the wealth of the organization. That means that will maximize the profitability of the company. So in this section, business decision analysis, we are going to learn some different topics. So here in business decision analysis, we'll discuss three different decision areas. That is starting with cost volume profit analysis. In short, we'll say CVP analysis. It's a kind of decision. And secondly, marginal analysis. This one also a kind of decision making. And thirdly, pricing decisions. So these three topics to be discussed under the section C, business decision analysis. So before dig into detail about each of the section coming, each of the topics coming under this particular section, we should have some basic idea about this particular area. That means we have to have some sort of idea about contribution margin income statement. So we know that the contribution margin income statement or income statement, we are so much aware about this particular topic. That means the term. What is a contribution margin income statement? Before discussing about contribution margin income statement, we should know about an income statement. What might be an income statement? It's a financial statement. You are aware about it, right? So it's a financial statement which is prepared by every organization to arrive the financial performance, in order to determine the financial performance of an organization. What might be the financial performance of an organization? It may be profit or loss. So in order to calculate the profitability or loss of the organization, we have to prepare a financial statement that is called income statement. So what is contribution margin income statement? It's a kind of income statement which is prepared by separating the cost into variable and fixed. Then what is the difference between normal income statement and contribution margin income statement? In normal income statement, we are segregating the cost into product cost and period cost. But here we are segregating the cost into variable cost and fixed cost. That's only the difference between normal income statement and contribution margin income statement. Then you will have a doubt why we are using this contribution margin income statement instead of normal income statement. Actually, the normal income statement we are using for external financial reporting. External financial reporting means external authorities should take the audited financial statements on yearly basis from each of the companies. For example, here in India, the companies are regulated by Security Exchange Board of India. Instead of that, in US, the companies regulated by Security Exchange Commission. For them, we have to submit the audited financial statements. As part of that, we will submit normal income statement. Otherwise, you would say traditional income statement. But here, the contribution margin income statement can be used for internal decision making process. What are the internal decision making processes? CVP analysis, marginal analysis, pricing as well. So, with the help of an example, we are going to discuss about the contribution margin income statement, how to prepare a particular contribution margin income statement. Here we have taken an example of a trading company. What kind of trading company is this? This is a trading company which is selling mobile phones. Okay, so the owner of the business is Miss Alita. She is pursuing a mobile phone trading shop. Okay, so using this example, we are going to learn about the contribution margin income statement of a trading company. Before preparing the contribution margin income statement, we will discuss the scenario. First of all, Alita is purchasing each of the mobile phone from external supplier for $400, and she used to sell each of the mobile phone for how much? $600. So is this only the business activity? No. Of course, she has to pay some sort of monthly expenses as well, in addition to this purchase price and selling price, of course. So here, monthly basis, she has to pay $1,500 rent and $200 monthly salary for her staff. Apart from that, she has to pay 5% commission for her sales staff on each dollar of sales. Suppose if she sell one unit, that will be for $600, she has to pay 5% of that $600. That will be the commission. So in addition to this, we have to pay this much additional cost as well. So as we know that the contribution margin income statement is an income statement which is prepared by separating the cost into variable and fixed. So our first duty is to separate the cost into variable and fixed. So before that, we have to segregate what we have revenue and what we have as cost. So as we know that we are purchasing each mobile phone for $400. This is a kind of cost for us, of course. Secondly, monthly basis, we have to pay a rent of $1,500. This one also particular cost for us. And thirdly, this salary for staff. This one also cost for us. And in addition to this, 5% commission on sales. This one also particular cost for us. So first of all, we are going to segregate these costs into variable and fixed. As we know, what are variable cost? Variable cost are costs which are changes proportionately to the activity. That means when the purchase changes, the cost also changes. Otherwise, if our sales changes, the cost also proportionately changes. Say for example, if you're purchasing one unit of mobile phone, we have to pay $400. What about the cost of purchase if you purchase two? That would be 2 into $400, that would be $800. The cost is proportionately changes. Then it is a variable cost. Okay. Secondly, regarding the rent, if you are selling one unit, we have to pay $1,500. If you are selling 2 units, we have to pay $1,500. If you are not selling anything in a month, we have to pay $1,500. So that cost will be fixed. This is not with regards to the activity. Activity means production, the purchase or sales. It's not regarding the purchase or sales. Here, with respect to the staff salary $200 per month. Whether we are selling 1 unit, 2 units, 10 unit, we have to pay $200 fixed, right? So this one also fixed cost. And thirdly, the staff commission. As we have discussed earlier, we know that each dollar of sales we have to pay 5% commission. That means here the sales of 1 unit is $600, right? This is our revenue or sales, we can say. So here the 5% of 600 would be how much? Let's say that is $30. If we sell 1 unit, we have to pay 1 into $30. If we are selling 2 units, we have to pay 2 into $30. If you are selling 3 units, 3 into $30. Likewise, it's proportionally changes. Then it will become what kind of cost? Variable cost. Based on this, we are going to prepare a contribution margin income statement for our internal decision making process. Let's start with contribution margin income statement. I have written in short for your convenience. As we know that in any income statement, in order to arrive at profitability, we have to deduct cost or expenses from revenue. Here, our revenue is sales revenue. Then we will start with sales. After that, we will deduct the cost. Costs are classified into 2, that is variable and fixed. Suppose Miss Alita used to sell 100 mobile phone on a monthly basis. We are going to discuss about her sales. What might be her sales? As we know that we are selling 100 units. For each mobile phone, how much she used to earn? $600. $600 is her selling price. Here 100 into 600 would be $60,000. From this revenue, we are going to deduct cost. What are the costs we have? Based on cost behavior, we have divided into variable cost and fixed cost. First of all, we are going to deduct variable cost. Variable cost. What would be the amount of variable cost? If you are selling 100 units, we are getting 100 into $600, 60,000 as revenue. So here the variable cost also for 100 units. As we know that the variable cost changes proportionately to the activity. Here, as we know that for 100 units, we have to give the variable cost. What would be our variable cost per unit for each mobile phone? If you are selling each mobile phone, what would be our variable cost per unit? In order to sell each mobile phone, we have to purchase it for $400. Apart from that, in order to reach this particular product to the customer, the salesman will ask for $30 commission. Altogether, $400 plus 30 for $30 per unit will be the variable cost per unit. So if you are selling 100 units, how much will be the variable cost? 100 into for $30. How much it would be? $43,000. Now it's time to deduct this variable cost from sales. It would be $17,000. We have to assign a name for this, right? We call this as contribution margin. In short, I have written as CM. Okay, so actually this is contribution margin. So from this contribution margin, we are going to deduct one more cost category we have, that is fixed cost. What would be our fixed cost? From this scenario, we know that our fixed cost is $1,700. That means that consists of rent of $1,500 plus staff salary of $200. Altogether, what would be our fixed cost? $1,700. Here we will deduct this 1700. If you are selling 1, 10, 100, even if you are not selling anything, we have to pay this $1,700. When we deduct this 1,700 from our contribution margin of 17,000, our profit would be 15,200. In this profit, we have to assign a name, right? We used to call this as operating income, otherwise operating profit also we can call operating income or operating profit. In other words, we used to call earnings before interest and tax. That means before paying, it's a profit before paying interest to the debt holders and tax to the government. So before that we will have this much amount of profit. From this profit, first of all we have to give interest to the debt holders. That means if you have taken some sort of loan from bank or from any other financial institutions, we have to pay interest for that, right? So that interest should be given first. We are going to deduct the interest, but unfortunately here in internal decision making process we are ignoring the finance cost. That means interest we are simply ignoring. That's why our interest would be 0. Now if we are deducting 0 from 15,300, our again it will become 15,300. This is called earnings before tax. Before it was earnings before interest and tax. Now we have deducted interest. Even if we don't have the interest, we are simply deducting for the sake of showing the calculation. Here 15,300, this will also same as to operating income or earnings before interest and tax. Now we have deducted interest from this amount. Now it will become earnings before tax. Interest portion is already deducted. Now it will become earnings before tax. Now it's time to deduct tax. Let's say, assume that in our country we are paying 40% tax. 40% tax from the taxable income. This is the taxable income. That means this is our profit before tax. From this amount we have to give 40% tax to the government. Let's say 15,300 into 0.4. You would say 6,120 would be our taxable amount. Tax amount we have to pay. While we deducting 15,300, 6,120, 9,180. What will be the name of this particular profit? We used to call earnings after tax. Otherwise we can say net profit. Net profit. Here we know that the profit is divided into 3 parts. Operating profit, otherwise you would say earnings before interest and tax, and earnings before tax, and earnings after tax. Here we are selling how many units? We are selling 100 units, right? Instead of that 100 units, now we'll take the example of 200 units instead of this 100. Let's take an income statement based on this particular quantity. As we know that our variable cost per unit is $430. That means this 400 plus $30 commission, and our total fixed cost is $1,700 per month. Based on this data, we are going to prepare another income statement. Here, as we know that, we'll start with sales. Our sales would be $200 into how much? $600. Our sales would be $120 $36,000. Now it's time to deduct variable cost from this. Our variable cost is for also $200. So $200 into $430 would be our variable cost. That would be $86,000. We'll deduct 86,000 from 120,000. That would be $34,000. We know that this is contribution margin. From this contribution margin, we'll deduct fixed cost. As we know that in previous case, if you are selling 100 units, our fixed cost would be $1,700. Now it's time to sell 200 units. Here also our fixed cost would be same. That is $1,700. So when we deduct this 1,700 from 34,000, our profit would be 32,300. We know that what to call for this? Earnings before interest and tax, otherwise operating income. I am writing in short. Operating income, otherwise operating profit, otherwise we can call earnings before interest and tax. From this amount, first of all, we have to deduct interest. Here we are ignoring the interest cost, then it is 0. When we deduct this 0 from 32,300, same 32,300 would be the earnings before tax. From this earnings before tax, we have to deduct what to arrive at net profit or earnings after tax. It's only the tax. We are assuming the tax amount as 40%. This is simple our assumption. So 40% of 32,300 would be 12,920. Here we are gonna deduct 32,300 minus 12,900 is equal to 19,400. This is our earnings after tax, otherwise profit after tax. We also call this as net income or net profit. Hence, this is profit before tax, this is profit after tax. This is operating profit. That means profit before interest and tax. Here we know this is our net profit. As we know that our quantity only changes here in this income statement as well. See, our selling price is not gonna change. Variable cost per unit also not gonna change. Then our contribution margin per unit also not gonna change. As we know that sales minus variable cost in total will become contribution margin. Then selling price minus variable cost per unit will become contribution margin per unit. We can arrive at this amount by multiplying 200 into 170. Also we can become 34,000. Instead of that, in what way we have done? Total sales minus total variable cost in order to arrive at contribution margin. Again, regarding the fixed cost also same as in the case of 100 units of sales. So here the changes only comes with respect to the units. When the unit changes, it will impact the overall contribution margin and the profitability as well. Now, from this we can discuss regarding some technical terms. As we know that this is selling price, this is variable cost. When we deduct this variable cost from sales will become contribution margin. Likewise, when we deduct this variable cost per unit from selling price, that would become contribution margin per unit. Contribution margin per unit. How to calculate this contribution margin per unit? Selling price minus unit variable cost. Otherwise we would say variable cost per unit. And what is contribution margin then? Contribution margin, overall total contribution margin is equal to this sales minus variable cost. Sales minus variable cost. This is in total and this is in per unit basis, right? And we can calculate some ratios out of it. This one also some basic premises which we are gonna derive from the contribution margin income statement. What is, see here we have a contribution margin of $34,000. This 34,000 is a certain percentage of this sales, right? How to calculate that percentage? This is simple. 34,000 divided by 120,000. What we are going to calculate? This amount, that means contribution margin is how much percentage of sales. So 34,000 is the contribution margin, and out of sales it would be, let's say 0.283, let's say 28.3%. If we multiplied with 100, we will get the percentage, otherwise we will get the fraction amount. As we know that when we multiply this 0.283 with 100, it would become 28.3%. And what about this? This variable cost, how much percentage of this particular sales? How to calculate that? That one also very simple. 86,000 divided by 120,000. How much it would be? Let's say 71.6 almost. That means 0.716 in terms of fraction, but the amount will be, the percentage would be 71.6%. So this denotes this contribution margin is 28.3% of this sales, and this variable cost is 71.6% of sales. We can call this as contribution margin ratio. This is called contribution margin ratio, CMR. Okay, then what is the name for this? We used to call variable cost ratio. So we can determine one formula here. What will be the formula? Contribution margin ratio is equal to, what is this? 34,000 is our contribution margin, and what would be 120,000? That is our sales. So contribution margin ratio is equal to contribution margin divided by sales. Then what would be the variable cost ratio? We know that variable cost ratio is equal to, this is variable cost in total divided by, this is our sales. So this is called variable cost ratio. Here we are calculating the contribution margin ratio and variable cost ratio using the total contribution margin compared with sales, total variable cost compared with sales as well. But based on per unit basis also we can calculate the contribution margin ratio and variable cost ratio like this. Let's say contribution margin ratio is equal to, instead of this contribution margin in total, we are taking contribution margin per unit divided by, instead of sales in total, we can take selling price, that one also per unit. How to calculate variable cost ratio using per unit basis? Instead of this variable cost in total, we are going to take variable cost per unit, and instead of this sales total, will take selling price per unit. In both way, if you are calculating, the result would be same. This is how we are preparing a contribution margin income statement and deriving the formulas out of it with respect to the trading company. Just before, we have discussed the preparation of the contribution margin income statement of a trading company. Now it's time to learn the preparation of contribution margin income statement but the manufacturing company. We are taking the example of a company which is Box Gallery. What is their business? They are producing carton box. By purchasing the material from external supplier, using their own labor and other expenses, let's say overheads, they are producing the products in-house, and when it becomes the final products, they are selling to the customers. We are gonna take the example. As we know that, same as to the previous example, we are dividing the cost into variable and fixed. As we know that the variable cost or cost changes proportionately to the activity. Here the variable cost are given in per unit basis and fixed cost are given in total for the easiness of understanding. Each of the carton box we are gonna sell for $20. Based on this example, we are going to prepare a contribution margin income statement of a manufacturing concern. How to prepare contribution margin income statement? As we have already learned, any income statement is starting with sales. Here also we are taking an example. We are going to sell 1,000 units of carton box. Each unit we are selling for $20. How much would be our sales? 1,000 into selling price $20. It would be $20,000. From this revenue, from this sales, we are going to deduct variable cost. Our variable cost would be for 1,000 units. That means we are selling 1,000 units. We are earning revenue for 1,000 units. Here the variable cost also for 1,000 units. For each unit we have to pay $8 as variable cost. Then for 1,000 units, 1,000 into $8, it would be $8,000. When we deduct this 8,000 from 20,000, we'll get $12,000. We used to call this contribution margin. Why it is contribution margin? It is an amount which contributes to cover fixed cost and profit. That's why only we are calling this as contribution margin. From this, first of all, we have to cover fixed cost. The rest of the amount would be profit. Here, as we know that the fixed cost is $6,000. If we are selling 1, 10, 100, everything, the fixed cost will be fixed. It won't changes. Here the profit would be how much? 12,000 minus 6,000, it would be $6,000. We used to call this as operating income. Operating income. Operating income. Otherwise, earnings before interest and tax. Earnings before interest and tax, EBIT. From this, we are going to deduct interest. As we know that as part of internal decision making process, we will never consider finance cost, that means interest. We'll give here 0. 6,000 minus 0 is equal to $6,000. We call it as earnings before tax, that means profit before tax. From this amount we have to deduct tax amount. Here also we are taking our tax percentage as 40%. So the 40% of 6,000 would be $2,400. When we deduct this 2,400 from 6,000, we'll get $3,600. This is our earnings after tax, otherwise net profit, otherwise net income. In any manner we can call. In different names we used to call this. This is our operating income, otherwise earnings before interest and tax. This is our earnings before tax, that means pre-tax profit. This is after tax profit, earnings after tax, otherwise net profit, net income. In different manner we can call. Here we know that in both cases, in trading company or manufacturing company is concerned, the operating income and earnings before interest and tax, that means pre-tax profit, are same. Why? It's only because there is an assumption behind the internal decision making process is that interest should be ignored. So here onwards we used to call the operating income also as pre-tax profit. Why? Only because the interest is ignored. Here in coming days, if you prepare a contribution margin income statement, sales minus variable cost would be contribution margin, minus fixed cost would be operating income and also pre-tax profit. If we given here as a pre-tax profit, this is not wrong here in this case. Okay, this is how we prepare the contribution margin income statement of a manufacturing concern. As we have already derived the formulas for contribution margin ratio, variable cost ratio, how to calculate the contribution margin in total, how to calculate the contribution margin per unit, everything we have already derived from the keys of a trading company. So we have already discussed about the preparation of contribution margin income statement of a trading company as well as a manufacturing company. Your base are strong enough to move to our major topics in business decision analysis. We'll be going to cover in next classes. Thank you.